confidence, control, knowledge, safety, success, investing, making money, money school. What are stocks and bonds? That's where you'll start and move rapidly into the how-tos of working with a broker, buying stocks and bonds, reading the financial pages, and so much more. Craig Lewis, certified financial planner and longtime money manager, will be your guide through the financial jungle. The goal is for you to gain the knowledge you need to make informed decisions and succeed. And now your guide, Craig Lewis.
If I had $2,000, $5,000, or $10,000 to invest, I wouldn't be able to hire a full-time professional to manage my money. You saw how the commission structure works. If I'm going to buy $10,000 worth of stock and I want to diversify it between 10 stocks, that's $1,000 in each stock. I don't even know that I could buy in round lots, and I definitely wouldn't be able to get very good attention. And I'm going to have more of a hodgepodge of stocks than a carefully diversified portfolio. I can't really buy and sell during the course of the year because that could cost 15, 20% just in commissions. So what do? We can think of a mutual fund as a large pool of money. In that pool of money, let's say we all put in our $2,000 or $10,000 or $25 a month, and we've gotten up to $1 million. With a large pool of money, we could together go out and hire a professional. So we have a professional looking over our large pool of money. And that is basically the concept of a mutual fund. How that mutual fund acts is going to be determined by what that professional does with that large pool of money. Say they've got $1 million and they decide to put that in aggressive growth stocks. How's that pool going to act? Well, it's going to move quickly with the market. If the market goes up, it moves up. If the market goes down, it moves down. If instead they buy blue chip stocks in there, how will it work? It will normally pay a lot of dividends, and it won't be as fluctuating as aggressive growth stocks. They could take that $1 million and go out and buy bonds. If they bought bonds, then if interest rates went up, the value would go down. If interest rates go down, the value would go up. They could buy nothing but government bonds. If they bought government bonds, it might be that they buy some Ginnie Maes. Or we could ask them to take that $1 million and buy nothing but municipal bonds. They pay tax-free interest. Whatever we told the professional manager as investors that we wanted them to do, we would hire a professional to manage that money, although we only had $2,000 to put into it. We know how it is going to act because it says what the professional can do in the prospectus. What can sometimes be confusing is that you don't normally buy bonds in terms of shares. Because the mutual fund concept is not affected by what you put into it, the concept is always the same. The concept is a diversified, managed portfolio of whatever is inside that portfolio, and you will buy shares of that portfolio. So if you have stocks or bonds in it, it will be the same concept. At the end of the day, they've bought some and they've sold some, they've had some money go in and some money go out. The demand or the supply for the open-ended mutual fund does not affect the price of the mutual fund. What affects it is what takes place internally. Inside the mutual fund, they can sell or liquidate as many shares as they need to during the course of the day. At the end of the day, they push a button and it tells them what the whole pool is worth. And they say, tell me what the net asset value of the whole pool is worth. They divide it by the number of shares. So if I have 100 shares, my net asset value could be $16 a share. And that is what the liquidating value is worth. Now when you buy into a mutual fund, it will tell you what its objective is. It could be growth, income, or growth in income. It could be total return. We're going to buy some stocks, we're going to buy some bonds. You'll be asked to choose if you want to let those dividends pay out, or you have the option of reinvesting them into more shares. As the professional buys a stock at $5 and sells it at $6, we're going to have some capital gain. You'll be asked to choose if you want to let that pay out or let it reinvest into more shares. It could be a pool of stocks or bonds or real estate or gold or coins, all expressed as shares of the value of the pool. Now, how do you buy a mutual fund? There are three or four different kinds of fee structures you need to understand. The first is called the front-end load. It works like this. As an example, you have the net asset value and you have the offering price. If you invest $1,000 to $10,000, they're going to charge you 8.5% of the asset value as a sales commission. And they're going to have breakpoints. From $10,000 to $25,000 is 6.5%. From $25,000 to $50,000 is 4%. From $50,000 to $100,000 is 3%. From $100,000 to $250,000 is 2%. From $250,000 to $1 million, it might be 1.4%. Different funds have different sales loads. The net asset value is what your liquidating value is. When they push the button, that's what the whole pool is worth. The offering price is what you will have to pay to get into the fund. Normally the load funds are sold through brokerage firms, and it is how you pay the broker to help you choose the funds and watch the funds and make sure that all is going well. Then we have what is called the no-load fund. These are bought directly from the fund. Normally you have an 800 number that you are able to call, get the prospectus, send your money off, and watch it in the paper. On the load fund, there is a letter of intent which says if I can put $5,000 in now, but I hope to get $25,000 by the end of the year, I can sign a letter of intent. That says I intend on putting in more money up to the $25,000 by the end of the year. Maybe a profit sharing plan, or you have some CDs that are maturing at different times. The letter of intent allows you to get a better break point, but with a smaller amount of money. And as you build it up, you do so at a lower commission. If at the end of the year you are not able to meet the break point, they just take the rest of the commission out. Then there's the 12B1 fee. That means that they are going to take out a percentage fee each year for the sales commission. You wouldn't actually see this fee. It's charged against the entire pool, not each individual account. There may be a penalty for early withdrawal called a redemption fee. Sometimes, if you were to get out within the first year, they will charge 5% or whatever the redemption fee is. They might charge you 5% redemption if you get out in the first year. Second year might be 4%, then 3%, 2%, 1%, then nothing in the sixth year. There's also a management fee, the internal fee that is not charged against you, but is charged against the whole portfolio to pay the professional. It may range from 0.5% to 2%, but it's usually around 1% of the portfolio goes out into management fees, and that is an internal fee. That's the normal fees to look for in analyzing mutual funds. Look in some fund prospectuses for the fee structures. There's also a pooled investment concept called a unit investment trust, a UIT. Let's collect $1 million pool and hire a professional to buy a bunch of bonds. After that, he leaves, and those bonds simply operate. They pay their interest, they fluctuate with interest rates, but he is not actively managing it. So it is a set trust. We'll normally see this in the municipal bond side. There is little reason to buy a 30-year municipal bond to manage. If they are AAA rated or good quality bonds, there's not much management that needs to take place. So we buy a unit investment trust of bonds, a diversified portfolio, so you are not locked into one or two bonds. The professional has done a good job of getting good bonds at good prices, and then he leaves, and it just operates. The advantage of the unit trust is that normally bonds pay twice a year. Normally, if you have $10,000, you can't diversify. If it is municipal bonds, they may be bought in $5,000 increments for one bond. So with a UIT, you take your $10,000 and you're able to buy a diversified portfolio of municipal bonds. And they're able to offer you semi-annual, quarterly, or monthly payments. They can also take that entire portfolio or bond by bond and insure it. You have an insured municipal income trust, a unit trust, because you buy it in terms of units. Each unit may start at $1,000. Each unit consists of a diversified portfolio of bonds. And that is a mutual fund concept, but is not actively managed, so we call it a unit trust. Also, normally each mutual fund manager or management company has a lot of funds. Look at this example. They call this a family of funds. It may have from aggressive growth, blue chip, index, total return, international, corporate bonds, government bonds, muni bonds, and money market funds. They will normally allow you to switch back and forth between an aggressive growth and a money market. So when the market's going up, you're in the aggressive growth, or you're in the total return. Or you want to get out because you think the market's gone up enough to get into the money market fund. Or your objectives change and you decide you want to stop having the growth and go into the bond fund where it will pay you a monthly income, or go into a government bond because you're afraid of the corporate market and you go into a government bond fund. Or you can do what is called a withdrawal plan. If you have more than $10,000, most mutual funds will allow you to do this. You take your fund and tell the fund manager to send you a check each month for $500 or for 5% or 10% or whatever. Then if the fund grows 6 to 10%, you may be going into your principal. But if it's growing 20 to 25% and you're taking 5 to 10% out, then it continues to grow and pays you a monthly check. Also available for most mutual funds is an automatic investment plan, where you are putting in $25 a month for the next number of years. A lot of mutual funds will do an automatic investment plan where you sign a draft and it will take, for example, $100 a month from your checking account for automatic investment draft. So a mutual fund is a pool of money, actively managed, a diversified portfolio that you are able to control, only in the respect that you tell them what your objectives are, and they try to meet those objectives to only buy the kind of securities that you tell them to buy. Now this is an example of a mutual fund quotation from the newspaper. In the upper left-hand corner is the Fidelity Advisor family of funds. The first column is an abbreviation of the fund name. This is not the ticker symbol for the fund. Next we see that the investment objective is growth. The NAV column is the net asset value, or liquidating value. The offering price is the buying price with the maximum commission or load built in. The NAV change is the net asset value change from the previous trading day. Then different newspapers offer various information on the funds. When you see NL under the offering price category, as you do in the Fidelity Invest family of funds, it means no load or sales charge. Funds with redemption charges or other features often use footnote symbols or letters.